Everyone, Logan Hertz here with Hazeltine LLC. We've got back after too long of an absence. Peter Nelson, Nelson Insurance Advisors. Peter, it's been a long time. How have you been?
Logan, God bless.
Are you still in the business? You
I'm still
still
doing it.
there? Still there? You still there?
Deer season's over now. The holidays are over, and so yeah, I'm back.
Peter is still here. He is still around. Okay, good. People were worried. Okay. So today I thought we'd talk about a topic I've not broached before, and that is the topic of annuities. We're going to go through very briefly annuities and then what Peter considers to be the best annuity on the market right now. So I can offer annuities, but if we get a little more deeper into annuities, I like to bring in someone else who knows a bit more about annuities than I do. My specialty is really infinite banking and specially designed whole life insurance policies. So we're going to talk about what an annuity is, why would you use it, and then we're going to go through what Peter considers to be the best annuity on the market right now and why he thinks that. So I'll give my understanding and then I'll hand it over to Peter to give the correct understanding. So, what is an annuity? Annuity is basically an income generation tool. So, one of the challenges people face is that they build up a large nest egg in some kind of market based account, whether it be a retirement account, whether it be just in a brokerage account. And as they're approaching retirement, their question is okay, I built up this $1 million nest egg. How long is it going to last? How can I make sure it's going to last me through all of retirement? Because what they start to realize is they realize it's not about the size of my nest egg when I'm approaching retirement. It's about how much income can I generate? How much safe, reliable, passive income can I generate? And that's where an annuity comes in. An annuity is an income generation tool. And the typical use case is you take a lump sum that you've built up and you roll it over into an annuity, which now gives you a guaranteed income stream for life. So now I know that money will never run out. So, as an example, let's say I have $1 million. There's something called the 4% rule, which means if I have $1 million in a retirement account, I cannot safely withdraw more than 4% per year if I want to make sure that nest egg doesn't run out. And even if I withdraw only 4% per year, there's still no guarantee that the money won't run out, but it's pretty likely, like a 90% chance that you won't run out of money. So if I have $1 million, I can now only safely withdraw $40,000 per year in income if I want to make sure that money doesn't run out. Whereas if I roll it over into an annuity, I might get 6% or 8% as a guaranteed lifelong income stream. So now, instead of collecting $40,000 per year and still being unsure whether my money is going to last for the rest of my life, now maybe I can get $60,000 or $80,000 a year in income, and it's guaranteed to last for the rest of my life. And the people who offer annuities are life insurance companies. The reason they can do this is because they have what they call mortality credits. Okay. We don't have to go into all of how that works, but that's the unique position an insurance company is in and why they can give you this guarantee, right? Because they have both life insurance and annuities. Okay. The most common form of annuity sold is what's called a single premium income annuity. And that is exactly what I just described. You take a lump sum that you built up, you hand it over to the insurance company, and they give you a guaranteed lifelong income stream in return. And the older you are, the better it is because it is mortality based. You don't go through underwriting, it's based purely on your age and gender. But the older you are, the higher the income stream they can give you, which is why it's typically done as a retirement play. It doesn't have to be where you're older so they can guarantee you a higher income stream. It's basically based off current interest rates and your age. Okay. There are basically three different kinds of annuities. One would be what I just described, which is a simple income annuity where you're just being given a guaranteed interest rate as income. Okay. The drawback is you give up the lump sum. So you give it the liquidity. So if you have $1 million in the market, you have $1 million in theory. Once you purchase the annuity, you don't have that $1 million of liquidity anymore. But what you do have is that guaranteed lifelong income stream, which when you approach retirement becomes more important. And again, there's a whole lot of nuance I'm skipping over. I'm just trying to simplify it. The second form of annuity is what's called a fixed indexed annuity, which is where you get exposure to the upside in the market, but you have protection to the downside. Okay, so up to a cap. So let's say the cap is 7%. So you take money from your market based account, roll it into a fixed indexed annuity. The value of that annuity will go up to a cap, let's say at 7% if the market goes up. But if the market crashes down, your floor is 0%. And then at some point in the future, you can then turn that into an income stream when you're ready to receive the income. Okay. So instead of it being just a simple interest rate you're being paid, it's somewhat variable based on what the market is doing. And then the last form of annuity, which we're really not going to get into today, is a variable annuity, which is market based. Keyword there is variable, there's market risk involved. But the difference is when you're in an annuity, you are in an income generation vehicle. If you're in just the stock market or something like that, you're in an accumulation vehicle. You're accumulating a nest egg. But an annuity is not intended to accumulate a nest egg. It's intended to distribute income, which is what's so important in retirement. So, Peter, I know I said a lot there, and I'm not a super expert in annuities, although I know enough to be dangerous. So, Peter, you want to maybe give your understanding of what an annuity is? Why would people buy one? What are the different kinds?
Yeah. So let me just say up front that we could literally do, and maybe we should, I don't know, Logan, but I could spend hours talking about this really to do this justice. Okay. First of all, let me just say up front, we're going to get out because we might show an illustration or two here. Okay. Terms and conditions apply, not available in all states. Okay. I'm getting my compliance out. All right. We're trying to do something that really needs to be done in regards to annuities. But at the same time, there's a lot of nuances. I guarantee we're going to be attacked for something we say. Okay. We're doing
No, that never happens, Peter.
no.
That never happens.
We're trying to educate people because you got to understand something right now. There's literally annuity sales are going through the roof right now. Billions upon billions of dollars are going into it. Okay. And some people say, oh no, annuities are bad and blah, blah, blah. But you got to understand they're really an important part of a portfolio. And the people that are not taking advantage of them is because one, they're told some lies and they also just don't understand them. Okay. So I wanted to get that out right now. What is an annuity? There's actually a book here if I can find it. Oh, actually, really quick. So after we give this talk, I'd recommend going out and buying this. Carrie Pector wrote this book, Annuities for Dummies. It's an amazing book. Carrie actually has a website for advisors called the Retirement Income Journal. I highly recommend it for any professionals that are watching. Retirement income is something that I focus on. Okay, so I got that disclaimer. Get this book, really good. There's another one by Dr. Wade Pfau we could talk about later on. I've showed it on the thing before. So an annuity in its simplest form is just a tax deferred account. In its simplest way. Now, we could get into, okay, but it provides a guaranteed paycheck for the rest of your life, right? But not necessarily, okay? I mean, literally a basic non-qualified annuity, when I say non-qualified, I mean cash going into it. It's really a tax-deferred savings account. Let's be clear. Let's simplify it. Let's pretend like your CD is a savings vehicle, right? But you have to pay taxes on that account as every year. As you make interest, you have to pay tax on it. All right. Not with an annuity. Okay. You can have something similar. We call them multi-year guaranteed annuities, for example. The difference is that you get triple compound interest. Okay. You get the tax deferral. You make, of course, there's interest on the principal, interest on the interest, and the tax deferred savings. That's why we call it triple compound interest. All right. So the definition of an annuity, I hate when, in a way, and this is just me, people say, this is the definition of an annuity. The definition of annuity is actually different based on what type of annuity you're talking. Logan, you mentioned an income annuity, right? Single premium immediate annuity, been around since the Roman Empire. All right. Now, are they popular today? Not as much as they used to be, as a matter of fact. And then we have your multi-year guaranteed annuities, which are the insurance company's version of a CD. Then you have your fixed indexed annuities, right? And then we can go up the rung. I'm not going to focus on these today. There's something called a registered index linked annuity. And then there's also a variable annuity. The variable annuities are the ones that people love to attack. I've sold them in the past. I don't currently offer them because I've gotten rid of that license. But variable annuities are the ones that get attacked all the time because they supposedly have all these fees. And we'll talk, probably get into the fee thing and all that later on. This, we're going to focus on the fixed indexed annuity. What I love about the fixed indexed annuity is it actually allows you to have kind of the best of both worlds in a way. You can turn on the income if you want to, but you don't ever have to turn on the income. And I really think this is, after doing this, actually, this month is my 23rd year in the business, Logan. I think this is what people want. They want to be able to access the money from these policies, get a competitive interest rate, have their principal guaranteed, but also still have access to their money, right? Would you agree that sounds like a pretty something that the American people would want right now?
Yeah, sure.
Okay. So, I mean, that in itself, see now what they'll tell you, let's get some of the objections out right away before we even talk about show an illustration or anything. What are the big objections? Oh, you lock up your money forever. No, that's absolutely not true. I'm going to show you on this annuity we're about ready to illustrate here. You could walk away after year 2 or year 3 with your principal. I don't think that's locking up your money. They're loaded with fees, Logan. Actually, what I'm about ready to show you is it comes in 2 flavors. There's a no fee option and there's a fee option. Now, I will tell you, we actually sell more of the fee option because you actually get something for it. Okay. What are some of the objections? I can make more in the stock market, right? Once
In the
again, this
Yeah, in theory, you could. Yeah.
once again, we're not saying this is going to compete against stocks, even though, by the way, I'll show you, Moshe Milevsky came out with some interesting research, but it's an amazing bond substitute. I even have a white paper here produced by Barclays, one of the biggest financial institutions on the planet, that says that FIA is a great substitute to a bond. There you go. Ernst and Young, did that whole big white paper showing that you should probably have about 30% of your portfolio in an annuity. I'm not saying you got to have all of your money in the annuity, okay? Even though there's some people I know that have a substantial amount in and they're loving life. So those are some of the objections right up front. Liquidity, fees, I can make more in the market. Those are the top 3 right there. Okay. And I would also argue that, and you've already touched on this a little bit, taking money out of an investment portfolio in retirement is not the most effective and efficient way to do things at times.
As one guy put it, when you're putting money into a retirement account, that is an accumulation strategy and an accumulation vehicle. It is not a distribution strategy or a distribution vehicle. And Peter talked about retirement income planning, which is a huge thing these days because as people approach retirement, they realize it's not about the size of my nest egg. It's about how much income. What is my strategy for distribution? That's what matters. And that's where an annuity can really help optimize what you built up in the market. Now, one of the reasons why parenthetically I haven't talked about annuities too much is because just for me, I don't really play the whole market game, but I certainly have clients who do. I certainly have people who have money in the market, and for people who have been accumulating assets in a market-based account, whether it be a retirement account or others. That's where I think an annuity could be a great way to optimize the income, maximize the income that you can safely, keyword safely, get it out of that particular vehicle.
Yeah. And I call it a foundational product. We have a lot of clients, they want to have their money be protected. They want it to get a competitive interest rate, but then we actually can use that money later on. Maybe we need to fund a cash value life insurance policy. We can take out free withdrawals. And I'll show that here in a little bit. But there's actually more flexibility. What I'm about ready to show you, there's more flexibility in an annuity than what people realize. A lot more. And that's why this annuity, we're gonna talk about, and we're not doing this just to pitch a product. I want to be clear. But
Yeah, it's to illustrate the
right.
idea. Yeah.
I,
Whenever we show numbers, the numbers don't speak for themselves. They're intended to illustrate a concept.
right. And I want to know, I'm showing this one because I honestly believe it's the most honest and true fixed indexed annuity out there. And we do sell quite a bit of it, but I've torn practically every annuity apart out there. And I'll show you some of the features why I think this one is so good. Plus it's with a not for profit. There was one other thing objection I just remembered, and I'll think of it again. All right. Do we want to jump into this one quick?
Yeah, let's
Hogan?
do it. Let's do
All
it.
right.
So we are, just to be clear, what we are showing you is a fixed indexed
Yeah.
annuity, or what we're
But
going to show. Yeah, go
yeah.
ahead.
And by the way, this is that white paper. Barclays did FIAs compared to bonds. Okay. This one's without the fee. So real quick, let me go up just real quick. So this company is GCU. They are a fraternal insurance company and not for profit. You've probably heard me talk about them before. GCU was founded in 1892. They are a 501c8. What does that mean? They don't pay federal income taxes. In return, they can't keep their profits. Okay. So once again, they can't keep their profits. So they're not out there trying to take as much money as possible and keep. Actually, their sole job is to take care of their members. Very key. See, when you take out a policy with a secular insurance company, those are clients, those are policyholders, right? Not with a fraternal insurance company. You're actually a member. You belong to something. I think this is really powerful. Okay. And I've talked about fraternal insurance companies on this program before. There's about 50 of them or so left in the country. Most of them were created back in the late 1800s or so, early 1900s. Really awesome. I'm a fraternal insurance guy. My FICF designation is a Fraternal Insurance Council fellow. I just love the fraternal insurance world. I know you do as well, Logan. I'm not going to get into all of this right now. Terms and conditions apply, not available in all states. Please reach out to me and Logan. We would love, if you're interested in this, you want to get into more nitty-gritty details, we will gladly have a no cost or obligation meeting with you to go over all this. Okay. This one here assumes $1 million goes into the policy. Now, this is going to instantly get a 10% bonus on all deposits. Okay. 61. So there's a 61 male, and it's non-qualified. Oh, that's what I was thinking of. People ask all the time, what if I roll money over? So if you roll money over from, say, a 401k or an IRA into this, there would be no taxable event because we would make the annuity an IRA. So you would only pay the tax when you pull the money out, no different than any other qualified account. Okay, I want to be clear about that. You can even make this a Roth IRA. If you have a big Roth and you want to roll into this, you can. And by the way, this in a Roth with a Roth chassis or wrapper, as I call it, is amazing because all the income would be tax-free, right? Okay, 10% bonus. We're going to start taking out, beginning in year 2, $70,000 a year. Now, what does that tell us right away, Logan? We can do
We're not
more
locking our money up. Yeah.
we can do more than 4%, can't we? Why can we do that? Because we've eliminated the sequence of returns risk in retirement, because we always know that the floor is 0. 0 is your hero. Did we index this to something? Yes, we did. Called the Barclays US Tech Fund. Once again, your money does not go into the index. I want to be clear. Your money sits at the general account. And what happens is GCU actually buys calls and puts. So your money makes interest based off of an index, but your money is not in the market. Okay. It's sitting in the general account at GCU. Let's be clear about that. Anybody that tells you differently, I give you permission to punch them in the face. That's the way this works. Now, I wanted to show you something pretty cool. You're going to take out 70 grand. Now, could I adjust this for inflation? I want to be clear. Yes, this is just a simple illustration. After 18 years, you've pulled out $1.1 million. You gave us $1 million. You pulled out $1.1 million. Your accumulation value is estimated to be $1.2 million. Okay. Now, if you die at year 18, this is what people, I drives me nuts. They tell you that the insurance company gets to keep all of your money. Wrong, wrong, wrong. That would only be an income annuity with a life-only option. Let me be clear. The majority of annuities in this country, you're not disinheriting your family. Okay? Anybody tells you that, I give you permission to punch them in the face. Now, of course, we don't wish physical harm. I'm joking, okay? So that's why this is powerful. is because if you get several market crashes over these 18 years, you're not going to be harmed. As a matter of fact, by the way, if you notice here, and if you add up this, the market typically goes up about 63% of the time, goes down about 37. So let's just say 60-40, up 60, down 40. If you do the math here, and if we count every time that this credited less than 1%, we'll count those as zeros. This illustration, which is back testing, is actually assuming that this is not going to make you any money about 40% of the time. So this is not a BS illustration. I want to be clear. There's companies that do have BS illustrations, not this one. This is one of the most honest fixed indexed annuity illustrations you will ever see. Any questions, Logan, about what I just went over here?
Yeah, so a couple of questions. First of all, that interest credited is based on an index which you are participating in. You want to talk a little bit about how that works? Because obviously, in order to give you the 0% floor, they have to either cap or have a participation rate where you're not getting full exposure to the upside. That's
Right,
the trade-off. So
right.
I just want to be clear to harp on something I always say. There's no free lunch. So when we say there's no fee, that's really not true. There is no fee called out, but there's always a cost associated with this. Otherwise, the insurance company could not make money off of this. And so, in this
Right.
particular case, you want to talk about what index is associated with, why you chose that index, and how GCU is making money.
First of all the money goes into the general account. When I say general account, that's the big pot of money at an insurance company. Every insurance company has a general account. That money goes in there. And then, of course, there are reserves, surplus. And then, of course, it's also invested. The majority of an insurance company's money is invested in bonds, both treasuries, corporates, all other stuff. Companies, I'm not going to go into exact what they're investing in per se, but some companies are more aggressive with what they invest in than
Well,
others.
but the point I'm making, Peter, is that go up to the participation rate. That's how GCU is making money, right? There's either
Well,
a participation rate or there's a cap.
I,
And that's how,
I don't want to get into that particular thing, Logan, but yes. So the calls and the puts are the way they protect it. And yes, they can make a little bit off of that. I'm not going to get into how all that works, but just understand the money's sitting in the general account and that they're going to make more off of that. Also, they're going to charge a fee here in a second. I'm going to show that. Once again, a lot of people say to me,
so what index are they participating in here for this one?
yeah, so this is the Barclays US Tech. Okay.
And why did you pick that particular index?
Because this is the best performing one that GCU offers.
And I think one of the points that I've heard you make is that when you have a 0% floor, volatility becomes your friend.
Yes. Yes. Thank you for reminding me of that. It is the most volatile index. This product itself gives you the option of two different indexes, and there's 1 year and 2 year strategies, and then there's a fixed account. But the reason why we're using this index is because it's linked to the NASDAQ 100. And yes, you don't get all the upside participation. Okay. That's not the way this works. But I want the most volatile thing because my floor is zero. That's what makes this powerful. There's a lot of people out there that have their money sitting in money markets, CDs, short-term bond funds. They're making what? 3, 4, if they're lucky, 5%. What if we could get you a little bit more in this type of strategy? And that's the point of this, is that we can take potentially a little bit more risk, but our floor is protected and we can grow this a more effective and efficient way. Remember a couple years ago, money markets were making practically nothing. Like go back to 2020, money markets aren't ever going to participate in any of the upswings of the market. This allows you to do this. So once again, I'm not comparing this to the S&P 500 or the NASDAQ 100. I'm comparing this to a CD, a money market, a short-term bond fund, all of that stuff. That's where the fixed index annuity really shines.
Yep. So in this example, we put in $1 million. Starting in year 2, we collected $70,000 worth of income. So that's 7%. And when we're done after 18 years, we've collected cumulatively 1.2 million in income, and yet we still have 1.2 million in the annuity, which is more than what we started with.
And we assume that this would not make any money 40% of the time. That is
Right.
the power of this. And did you lose access to your principal? And I want to mention that real quick here. In this example, here's your cash surrender value. People say your money is all locked up. In this example here, they're pulling money out. But you could see, you can still, this cash surrender value, you could walk off later on. Okay. Take your money. So if you died, there's a death benefit column, right? That's what your beneficiaries get. You are not, this is not the annuity once again, where if I die, the insurance company gets all my money. No, that's not the way this works. Okay. So this,
Right, right. Now, one thing I want to point out, Peter, is you are not actually turning the income on with this annuity. So that far right column, you could collect a guaranteed lifetime income stream, but what you're doing is you're taking advantage of the penalty-free withdrawal feature on this annuity and showing that in this illustration, it actually works better. You want to talk a little bit about that? Because typically when people want to generate income from an annuity, what they're doing is they're turning on the income and getting a guaranteed lifetime income stream, but that's not what you're doing here. You want to talk a little bit about why that works?
yeah. And for a disclaimer, because I know someone's going to attack me for this, but yeah, thank you for mentioning that. I think this is a much more effective and efficient way. There is one drawback to this. Let me get it out of the way. Can I guarantee that my strategy here will ever run out of money? No, I cannot guarantee it. The only way to guarantee it is to turn on the income. Okay. But yeah, my way is better. I'm just going to say it out. Why is that? Why should I lock up all their money? That's the biggest objection to annuities just about is, oh, we're going to lock it up. I don't have access to my principal. No, that's not the thing. Let's pretend in year 10, by the way, because that's the surrender charge expires there, that they took out $630,000. They got $1.1 million of accumulation value. And Logan, you're my client, and you say, you know what, Pete? I just saw this incredible opportunity down in Florida. Real estate crashed. I'm going to go buy up a couple condos down there. See you later. Goodbye. They could do that, right?
Can they do a partial surrender, Peter, after the 10-year period?
Sure.
Okay.
They can do whatever they want to.
Great. That's actually really good.
You
Yeah, but
see,
I think so for me too, when you say lock your money up, well, hold on. There are always trade-offs. So there's no free lunch. It's all trade-offs. If you want something that's fully liquid, that's fine, but then you're not going to get guaranteed income from it. And so you have the same problem of sequence of returns risk, the 4% rule. So when they say lock your money up in jail, it's not like I'm getting nothing for that. The insurance company could not give you 100% full liquidity and at the same time guarantee you a lifetime income stream. They couldn't do that. So it's just doing what they always do, which is myopically focusing on the drawback and ignoring the benefits I'm getting from that. When they say high fees, a fee means nothing in isolation. If it's a high fee, but I'm getting exponentially higher value, then what's the problem? I don't see the problem. So it's
yeah.
all trade-offs. It's all trade-offs.
And by the way, Logan, I'm showing you a no fee here. Let me say that again. No fee. I don't know how many times that they're going to say there's so many fees on annuities. No, there's so many fees in your investments.
Yeah, but
Yeah.
again, the way the insurance company is making money is on that index, you're not getting full participation.
Right.
That's how they're making
Right.
money.
There's calls and puts on it, but this is a more effective way for income. So
Right.
this can also,
Right.
by the way, what we call a buffered asset in retirement. So what does that mean? You have your investment account. It's doing well. The years that your investment account does well, you pull the income out of your investment account. You let this grow. The years that your investment account gets clobbered, you pull the money out of here. Or, by the way, you just pull all your money out of this and let your investment account grow. You can do it different ways. But once again, show me anything else out there that is more effective and efficient for actually providing income in retirement. This is what the Wall Street firms and the gurus out there, they can't beat this for retirement income. Okay? They can't. I'm sorry.
They don't even know it exists. I love educating people on this stuff. And again, we're not against the conventional approach. That's totally fine. It's just people generally know about that. They know about buying mutual funds and putting money in 401ks. They don't even realize this is an alternative. I was talking with someone the other day. We have a convertible term policy in force. We're probably going to convert it at some point to whole life. And he was just like, man, I didn't realize you could do all this stuff with a whole life insurance. I didn't realize you could design it this way and get so much early cash. I didn't realize you could generate so much income from it. And it's the same thing with annuities. I think most people don't really know what they are, if they even exist, and how they work. And once you just educate them on how they work, a lot of people want them, at least in some capacity. This is not an either or scenario. We're not saying get rid of your 401k, get rid of all those mutual funds. No, you can keep them, but why not have some of your money in something like this where you have the guarantees, where you're not exposed to market risk? And we have done a little bit on the psychological benefit of knowing you cannot lose money in these vehicles.
Absolutely. So here's the other
You-
one. Here's the fee one. They have this aversion to fees. First of all,
Mm.
if you were to purchase this from me or Logan, this fee does not go to us. This goes to right to GCU. But I charge fees for investments and all of that. I joke with people all the time and I say the only difference between this and what I do is hopefully I provide value for my fee. With this fee, I guarantee there's value. Because this does two things. One, it gives you a higher participation rate in the index. And two, this available lifetime income is actually a lot more. It's actually 2x factor, 2 times factor. So if you haven't done any long-term care planning, and let me just say that this is not a replacement for a long-term care policy up front. But let's hypothetically say, Logan, at age 80, they had unable to perform 2 of the 6 daily living activities. They could turn on the income here and they would double the amount. So it'd be $268,000 a year for up to 10 years for in-home care only. Let me be clear about that. In-home care only. Nurse would have to come out to your place. Here would be my argument. Why would I even turn it on? If I got $1.6 million sitting here, why would I not just take withdrawals out of it and do it that way instead of turning on the income? But the nice part about this is you have the choice. We can do the math when it comes to that point.
What's the difference in the participation rate, Peter, between when you have the fee and when you don't have the fee?
Great question. I got it right here. I can't show this due to,
Okay.
but I'll
You
tell
just
you
tell
that
us.
the US Tech 1 year, 70% versus 55.
There you go. So that is the cost, if you will. So you're not getting 100% of the gains in that index. You're getting 55%. Or if you pay the fee, you're now getting 70% of the gains in that index. So if you go back to the illustration, you'll notice there was a year where you got north of 20% gains in your annuities. You were not getting that without the fee. So if you look at age 76, year 14, actually year 4, age 66, also you're getting 23.24% gains. You were not getting that in the others. And so what we see is in this illustration, you do better with the fee than without the fee. So you still pull the same 1.2 million in income, but now you have almost 1.7 million in the accumulation value, and you have a
And
higher lifetime income available.
yeah. And let me just mention something too, because I'll get attacked on this. There's technically 4 chassis of this product. The only 2 chassis we're showing today are the 2 with the 10% bonus. There's actually 2 others. And in certain situations, it might make sense to have those. That's where,
Yeah, we forgot about the 10% bonus. You want to talk about that?
oh yeah, I did mention it. Any deposits you make on the 2 that we mentioned, you get a 10% bonus.
Yeah, so look at that accumulation value in year 1. It's not a million. 1.1, you get 1, so you have 1.1 million effectively. So as soon as you purchase this annuity, Your
Or
1 million turns into 1.1 million.
they deposit $100,000 into your account that earns interest.
That's pretty powerful. That's pretty powerful.
Yeah.
10% bonus up front.
Yeah. Does a CD or money market or short-term bond fund ever offered to do that?
Yeah, the only bonuses I'm aware of are the ones you have to work for.
Yeah. So anyways, that's
So
pretty cool.
the reason why I like this is if you look at that fee column, a lot of people, they go, "Oh, no, there's high fees." Hold on. First of all, it's optional. If you don't want the fee, you don't have to have it. But what are you getting for that fee? That's the question. We got to start with the value before we even get to the fees.
And by the way, Logan, it's 95 basis points. You know, and I know that there's plenty of investment companies and advisors who are charging more than 95 basis points. That's out the
Yeah.
door. That's everything. It's not going to go up 95 basis points.
Yeah. So for people who don't know what a basis point is, that's 0.95%. So a little less than 1% is what that fee is, a little
Right.
less than 1% of your deposit. And that's about what an investment account would charge. And usually it's more like 1.5% when you include all the fees, because the mutual funds charge fees, then the broker dealer charges fees, and the financial advisor charges fees, which I'm totally fine with. I don't have a problem
Yeah.
with people charging fees. They're not going to work for free. So I'm fine with that. I have no
I
problem
agree
with it.
with you. I agree with you so much. When people start saying, "Oh, my indexed account only charges 0.03%," stop. It's all about the only time that that stuff happens is when there's an absence of value, right?
Exactly. Then it becomes a race to the bottom. It becomes now we're just arguing over price. No, I never want to compete based on price. I want to compete based on value because the price considered in isolation is meaningless. A Honda Civic costs less than a Ferrari. Does that mean a Honda Civic is better? No, it just means it's a different vehicle. You're buying a different car. It's not like you're getting no additional value for the additional money you pay for a Ferrari. Same thing with if you look at a house and one house costs $500,000 and another house costs $250,000. You immediately conclude that the $500,000 house is a total ripoff and you should always buy the $250,000 house. No, obviously there's a reason why there's a difference in price. Price and value are
Right.
connected.
Just like when I bought my truck, I didn't walk up and say, "I want the stripped down model." My dad actually did this, by the way. He regretted it. He actually got the Toyota Tundra, actually didn't have power locks. And then later on, he was complaining. I was like, "You got the stripped down model. I got the TRD off-road package. I knew what I wanted." How many
Yep.
people do you think walk into a car dealership and go, "Yeah, I want that stripped down one"? No. So this is just a feature. And by the way, what I always say is, really, all you care about is the net, right?
Right.
This is the net.
Well, and the income. Yeah. Yeah.
Right, but they say, "Well, this got this fee." Yeah, well, I don't care. All I care about is the net number.
Exactly.
So in this
Exactly.
example, yes, you were charged the fee. You took out the same amount of money, but your accumulation value, I believe, was about 400,000 higher.
Yep. And so the fee gives you a higher participation rate. So the gains in that interest credited column are higher. That's what you're paying for. And so you get more interest credited to you. So like 23%, which you did not get in the no fee version. Plus, you get the long term care benefit, which is that if you have a long term care need,
Right
you can
here.
then double the available lifetime income. And Peter, I think there's a limit on that. Is there a limit to the number of years they can collect that? I think it's
10
5
years.
years. 10 years.
10 years.
Okay. For 10
Yeah,
years,
it's
which is
10
good. Yeah.
years.
Yeah.
So technically at this point, 268 for 10 years would be what? 2.6 million?
And then if they were still alive, they would then just collect 134. So the income wouldn't stop. It would just, the additional income
Correct.
would stop. Yeah.
Correct. Now, in that
What?
example, let's just
Yeah.
hypothetically say you got 268,000 a year for 10 years. Is that more than your accumulation value? Then there's no money left. When they pass away, the money's gone. Okay. I'm going to be clear.
And when they
Yeah.
turn on the income, what happens to the death benefit, Peter?
It adjusts based on how much.
Okay, but it doesn't go away. Okay, good.
No.
Yeah.
So
So the mind blowing thing for me is that what you're doing with this is you're showing how actually using the withdrawal feature can be more advantageous than turning on the income. So Peter pointed out the benefit to using the lifetime income is that income is now guaranteed for life. It will never run out. So if you'd use the withdrawal feature, by the way, the beauty of it is you could still take that lifetime income at some point in the future if you wanted
Sure.
to. but you could potentially get more income safely. How does the withdrawal feature work, Peter? I know there's a surrender charge within the first 10 years, and I'm sure they can't withdraw unlimited amounts. So can you talk about how that works?
Yeah, it's a 10% free withdrawal first 10 years. Now, remember, we're talking 4% on these retirement accounts, 4% rule.
Mhm.
So isn't that like 250% or right around there of
Mhm.
what they recommend out of a,
So the 4% rule would say if you had that million and you kept it in your retirement account or in the stock market, you could only withdraw $40,000 safely every year if you wanted to be sure to not run out of money. Here, you're safely withdrawing 70,000 without risking your
7%?
principal. Yeah, 7%. And of
Which,
course, in this
seven's a
example,
better, being Catholic, seven's a better number than four anyway. So that's why seven works so well.
of course, it's a biblical number. Yeah, yeah. I hope people are starting to understand how an annuity can work and where things get really interesting too. I don't want to complicate things too much, is how whole life insurance and an annuity can work together. So
It's
in
like
some
peanut butter
cases,
and jelly, like peanut butter and jelly.
so why would you want to turn on a lifetime income where it's life only and there's no return in principal, no death benefit? Well, you could get more lifetime income. And if you have a whole life insurance policy in conjunction with that, you have a death benefit already protecting you. So you could now, this maybe doesn't apply to the specific annuity we're looking at, but you can now maybe safely take more lifetime income from your annuity, knowing that there's a death benefit in your whole life insurance policy that's protecting you. So you're not worried about quote unquote losing your money because a death benefit's going to replenish all that, right?
By the way, Tom Hegna has talked about this for years. Now, this is in regards to ultra wealthy. We're talking people worth 30 million or more.
Uh-huh.
I'll give you the most simple estate planning ever. How to make all that money to make it work. You just reminded me of it.
This is so, let's not talk about it now, Peter. We can do a separate
Oh,
episode of that.
okay.
I know the strategy you told me; it's brilliant. We need to have
Yeah.
a whole episode on that.
Okay.
Let's not
All
bury
right.
it here.
All right.
So
Yeah.
stay tuned. We'll talk about that in another episode because it's a brilliant strategy.
The most simple and brilliant strategy. You'd be like, you'd fall over. You just,
So if you think you might have an estate tax problem, stay tuned. Uh,
yeah, but no, but I apologize. I got a squirrel brain. So I have all these, you mentioned something and I'm like, oh wait, we can do this. We can do that.
so simplest, let's go and call it a sales pitch. Simplest sales pitch for this particular annuity we're looking at here. Who is this ideal for, and what's the value?
Yeah. Well, this is what I say to people. I offer them benefits. I try not to sell anything to anybody. I actually want them to buy because Americans hate to be sold to, but they just love to buy. Love to buy. So would you like these benefits? By the way, we can do this as little as $10,000 to open up. Anything over a million, we have to get special approval, but I have gotten approval for over $1 million or anything in between. So would you like these benefits? Would you like your principal guaranteed? Would you like to get a 10% bonus on your money? Would you like to participate in some of the upswings without any of the downswings? For a non-qualified account, would you like tax deferral? Would you like to have a wellness benefit rider to help offset a long-term care event? Would you still like to have access to your money if you needed it and free withdrawals? And by the way, with the free withdrawal feature, did you know that if you don't use your 10% benefit, it actually rolls over to up to 30% cumulative free withdrawals? So then you actually even have access to more of the money.
That's really the key. Not only is your principal protected, where you can participate in the upswings in the market without hitting the downswings, is the amount of income you can draw out is substantially more than what you would get in a market-based account because it's an annuity. That's what it's built for. It's built to generate income.
And going back to the bonus real quick, didn't I just find you money that you didn't even know existed before?
There you
And
go.
can your CD or your short-term bond fund do that? When the light bulb goes off, they're like, wait, let's just pretend that we get the same returns. Let's just say the CD pays 4%, this pays 4%, but you get a 10% bonus over here on the deposit. Why would you not do this? Or at least take a portion of your money and do this? It is an absolute no-brainer. And I would always argue that I think the banks, I'm sorry, I don't think it's a good place to store your money. Now, this is what they're going to say. Here's the other big objection. I got FDIC insurance. Well, do you realize that for every dollar deposited in a bank, you got a penny backing it up? Now, I'm not saying the FDIC is going under or anything like that, but GCU's been around since 1892. They have no debt. They've never needed a bailout, and they've got a solvency ratio, really important, of 110%. It means they got $1.10 backing up every dollar. There's not a single bank in this country, including JP Morgan Chase, that has a solvency ratio of 110%. By the way, 110% for any insurance company. I'm going to show this, and I think we can probably wrap this up, but this is a powerful little flyer here, Logan. Here you go. And what's cool is they're based in Pittsburgh. They were founded by miners. My family is actually miners from Pennsylvania. It's another reason why I love this organization, because it actually hits. Now, they're from Pittsburgh. My family is from Eastern Pennsylvania. We were in the Bethlehem steel mines, the iron ore. We weren't in the coal mines. Iron ore mines are a lot safer than coal. But here's some of the companies, by the way. These are some big mutuals, right, Logan?
Mm-hmm. Mm-hmm. Yeah.
GCU solvency ratio is as high or higher.
Yeah. There you go.
That's why we trust so much of our client money with GCU, because we know that they've been here for over 100 years and they're going to continue to be. So
Excellent. This has been a good introduction to annuities and the GCU Aquila annuity, which is Peter's favorite. We
Oh,
certainly can talk more about this.
and one last, sorry, Logan. I if I don't show this, apologize.
And we didn't even cover, because we didn't have time, the Moshe Milevsky study showing that 0% floor. You end up doing better if you put your money into an account where you don't participate in all the upswings,
I
but
tell
you
you
miss
what,
out on the downswings.
I want to do a whole video actually on that one.
Yeah.
I have some other
Yeah.
stuff, but there's my agent testimonial. GCU actually did this for me as a top of table member of $1 Million Roundtable. I believe with my whole heart and soul that GCU's Aquila 10 is the finest annuity in the United States, and it's not even close. We proudly recommend it to our friends and family at Nelson Insurance Advisors and believe it has a place in the vast majority of America's portfolios. Yes, our own family members, my agents, myself, they own this product. This is not, I recommend this to friends, family, to our clients. I think every client should have a portion of their overall portfolio in the GCU Aquila. I just
All
wanted
right.
to share that.
There you go. So this is a good introduction to annuities and the GCU Aquila annuity. Peter, thanks so much for your time. Greatly
Thank
appreciate
you,
it.
Logan. I enjoyed this. Thank you. God bless. Godspeed.